All right, hello. In today's video, I'm going to be talking about a touchy subject. What's better, investing in an ETF or investing in individual stocks? If you're invested in ETFs or if you're invested in individual companies, this video is for you. So if you haven't already, please hit that subscribe button. It literally takes 2 seconds, so I have no idea why you haven't done it already. All right, let's jump right into it. ETF or individual? Let me ask you this. When you want chips, do you buy those combo pack multi-chip bundles from Costco? The bags that have like 10 different chips in them. You know what I'm talking about. It's oftentimes a better value. You get a lot more variety. You get a lot more options. You get chips you normally would have never bought by themselves. But this way, you get more exposure to the different kinds of chips that are available. You see what I did there? That's an ETF. On the other hand, there are some people who, when they want chips, they buy the 1 or 2 bags that they really like. They know what they're getting themselves into. They know that those chips are good. They know what to expect. You see what I did there? That's like investing in an individual company. So, which one's better? It all comes down to a matter of preference. Some people like to play it safe and diversify their chip options and buy a variety pack of chips. You get more exposure, you spread across multiple different options, you try out new chips that you would have normally never gotten. But in my experience, there's always that one bag of chips and variety packs that I don't like. You always end up either throwing it away or feeling bad about never eating it. It's just not an enjoyable chip. Same thing goes with ETFs. Sure, you have multiple stocks all in one ticker, but there's always that one stock in there that you wouldn't have bought, that you don't like, that you wish wasn't there. Another concept to note, you're spread pretty thin. If, for example, you love one of these chips that are in the variety pack, you wish you could have had more of that chip that you loved. If you love one of the companies that are in the ETF, if that one stock shoots up in value, your ETF will benefit. Sure, that bag of chips is still good, but it would have been better if you had that individual stock by itself instead of spreading yourself so thin. You would have enjoyed more of that chip if you only bought that chip instead of all of the other chips that came in the variety pack. I think you get the point. Now, let's talk about what I do. So every single month I get paid. I take that money that I earned and I deposit 10, 15, 20% of it into my long-term portfolio account. In that account, I build up cash, and then I hop over to my positions to see what I'm up or down on. I gauge where my dollar is the strongest. I pretty much make my own ETF by diversifying my positions in companies that I know, love, understand, use, and see used around me every single day. Listen to this example. I like Apple, Microsoft, Amazon, Facebook, Google, Tesla, Visa, and Disney. All of those companies are in the S&P 500. That means they are tracked by the SPY ETF. Sure, I could go buy SPY and benefit from all of those companies I just listed, but wait a minute, the S&P 500. So that means SPY has 500 companies that it tracks. If I buy SPY, I also get Intel. Well, I'd rather have AMD than Intel. If I buy SPY, I also get MasterCard. Well, I'd rather buy Square. If I buy SPY, I get Pepsi. I'd rather just add more to Coca-Cola and not split between the two. Again, if you buy companies that you know, love, understand, use, and see used around you, if you buy companies you expect to do what they are doing now, but better in 10, 15, 20, 100 years from now, and you hold it for the long term, in my opinion, you'd be better off being selective with your chips and enjoying those chips that you like. Another pretty cool strategy I've seen done successfully is looking at ETFs to make decisions on what to buy. I personally actually got a few investment ideas from ARK Investment, for example. Cathie Wood is the CEO of ARK, and they are an ETF that focuses on innovation. They think innovation is the key to growth. They invest in disruptive innovation. They buy companies that rely or benefit from the development of new products or services through technological improvements and advancements in scientific research. Well, at least that's what it says on their website. So you could just buy what ARK buys and call it a day. You could just buy ARK itself. They have a bunch of different ETFs that focus on different things, but in my opinion, every single one of those ETFs have companies in there that I don't really like, or I wouldn't have invested if I was investing by myself. I'm sure they have their reasons. I'm sure Cathie knows what she's doing, but I just don't like some of the companies that they invest in. I'd rather buy the ones that I really, really like and I really, really understand by myself. You can simply Google search any ETF and then type in holdings for a full list of what companies are in that ETF. For this example, since we're already talking about it, let's take a look at ARK. So we open up Google, we type in ARK ETF holdings. Click the first link, scroll down, click on Fund Holdings PDF, and boom, here's a full list of stocks that are held by ARK, organized by weight. So as you can see, they have a lot of Tesla, Square, Teladoc, Roku, Zillow, Baidu, Zoom, Shopify, Spotify, CRISPR, Exact Sciences, Twilio, Unity, DocuSign, and then a bunch of other stocks I don't really know or care about. They have some DraftKings. I'm sure all of those stocks that they're holding are fine. I'm sure this ETF will make some good money. They also actively trade it. But I don't know. I just rather buy the ones that I like. For example, I like Tesla. I like Square. I really don't like Teladoc. I like Roku. I like Zillow. I don't like Baidu. I don't really like Zoom either. I like Shopify. I like Spotify. I don't really know much about CRISPR. I don't know what Exact Sciences does. I don't like Twilio. I like Unity. I kind of like DocuSign. They have a little bit of DraftKings, but I really like DraftKings. So you see my point? Our weighting would be different. I'd rather buy what I like. Instead of buying ARK and getting exposure to all of these stocks, some of them I like, some of them I don't, I'll just pick and choose and buy my own. Now, it's very important to make sure that you're diversified though. I'm not saying go all in companies you like. I'm not saying don't buy SPY, only buy Tesla instead. No, no, no. You have to make your own ETF. You have to make sure that you're covered. You have to make sure that you have a healthy balance between growth stocks and dividend paying value stocks. A lot of people get wrecked when they go all in on highly speculative companies because they had a high conviction in their performance. But no, no, no. You need to make sure that you cover your basis. I'll make a video about this later, so make sure you subscribe so you don't miss it. But I'll make a video about my balancing strategy. I'm currently about 70% growth and 30% value right now. Since I'm younger, I do want to capture any growth potential of these companies that I know and love, but I also want to make sure that I'm utilizing the powerful benefits of compounding interest with these safe and stable and boring dividend paying companies. For every 10 growth dollars that I have, I make sure that I have at least $3 in a dividend paying value company. It's all about balance. Sometimes you got to sprinkle in a little bit of income producing assets like AT&T, IRM, Coca-Cola, or O. You got to make sure you get those Apples, Rocket Mortgages, Teslas, Airbnbs, Ubers, and Squares, but balance it out. Again, it's all about balance. None of this is financial advice. Everyone's financial decisions, financial future, everyone's situations are very, very different. Something that works for me will not work for you. Some things that work for you will not work for me. Everybody's different. Everybody's in a different age group. Everyone's in a different income class, different responsibilities, different priorities. There are a lot of factors that go into being successful in the stock market. So it's really, really up to you. And it sounds corny and cliche, but at the end of the day, you're in the right place if you're watching videos like this to get educated, because you'll get bits and pieces from my strategy. You'll hop over to another video. You'll get bits and pieces from there. You need to be a sponge, absorb all of the information, and create your own strategy. Make your own ETF. If you learned anything at all, if you found any bits and pieces from my investment strategy interesting, please don't be shy. Hit that subscribe button. Let me know if you have any questions or feedback in the comments below. I'd love to have a discussion about any of this stuff. And please, 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 please enjoy your day. Thank you, and I'll see you on the next video.